The Federal Reserve is holding a closed door meeting. And what does this tell us? I'm going to get into all of that, of course. The first thing I want to look at is what's happening with the Federal Reserve, specifically with this meeting first, and then we'll look at the actions and everything that's been happening recently. The second thing is the market's gone wild. How has the bond market and stock market been reacting to all of this? And the third is the consumer pressure. Right now, prices are rising, and that's why at least the Fed is trying to suggest that interest rates need to go higher. But what's been happening all along? We'll get into all of that and more. Let's begin. As always, directly from the source itself, you can see Federal Reserve website board meeting, closed board meeting on February 14th, 2022. Taking a look here, I'll just read through really quickly. It is anticipated that the closed meeting of the Board of Governors will be at 11:30 a.m. on Monday. So remember that. I'm going to post about this as soon as I possibly can. So make sure you stay tuned. Okay, this is being held under, let me get the highlighter here, under expedited procedures. Okay, important stuff. Review, this is the matter to be considered. Review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks. Big time important. Could this be, big question mark here, could this be the emergency rate hike that I spoke about in the previous video? Is it possible? Well, nobody knows, but we will have this discussion when the time comes. What happened the last time that there was an expedited FOMC meeting that I covered back then, by the way? You can see right here, Fed hikes rates for the first time since 2006, right after. So this could absolutely be the case. If they do, maybe they're going to do 25 basis points and then in the March meeting, another 25 basis points instead of doing 150 hike. Or it could be more of a signaling that they're going to do something in March. And maybe that's going to be 25 basis points. But they want to make sure everybody's on the same page right now. Who knows? That will only come in time. Okay, so we'll see. Now, this right here is key to watch as well. Because if you look at the actual structure as of now, because all of their purchases, the Federal Reserve, are known to the public, what we're allowed to know anyway. And you could see that. So when there were people saying that the Federal Reserve will not be doing this whole QT, quantitative tightening, that's not going to happen. Even today, people are still saying that. You can look at the schedule itself. The page and all of the other links will be in the description. So here you can see that. And it just shows you from $80 billion several months ago, 80 billion, then we went to 70, 60, 40, and the next is 20 billion. Okay, so you can look at this all for yourself. And some would say, well, that's actually just the schedule. They don't have to do up to that amount. But of course, all you need to do is go to a search engine and type in Fed H41, and you will see what they actually did purchase or sell or anything else. A firestorm of hawkish Fed speculation erupts following strong U.S. inflation reading. This is funny because, as they say here, it's going to be some even saying 75 basis points in March. I mean, what's going on? Literally just a month or two ago, there was no talk of this whatsoever. And now suddenly 75 basis points at once. They could be doing this, all this rhetoric, to then say, oh, we only got the 25 basis point. Oh, good. We're all good. What I find funny here at this point is those who said just a few months ago, there is absolutely zero chance that the Federal Reserve is going to do the quantitative tightening, and there's a zero chance that the Federal Reserve is going to hike rates. And now they're starting to say, well, yeah, they're doing it, but there's only going to be very little. It's going to be so limited. And that might be the case, but what about when you were saying they're not going to do it? So are you flip-flopping, or are you changing your mind? What's the story here? Can we talk about that? Because I think there's a problem. I think there's a real problem. And this is going on in the alternative media. Okay, we need to be asking some serious questions about these individuals who are starting to change their mind from what they said before to what they're saying today. Okay, look at this. The Fed doesn't yet favor a half-point hike or an emergency move. This is important because you can see they're starting to say, well, you know what? Maybe we don't want to, scare anybody at this point. This was 10 days ago, by the way. I showed you what Bullard said in the previous video. But the Fed's Bullard literally just 10 days ago, by the time you're watching this, probably 11 days ago, Fed's Bullard does not think a half-point rate hike would really help us. And then 10 days after he says this, suddenly, oh, we need to do a 50 basis point, a half-point rate hike. Make up your mind, buddy. Let's get serious. All right, now what's happening with the markets? And I'm going to directly link that with what's going on in the Fed. See, because Bullard is saying one thing, but what's going on with the others? The Richmond Fed president said, I'd have to be convinced for the need for a 50 basis point hike. There might be a time for that. Now's not the time. And then you have the San Francisco Fed president saying the 50 basis points, not my preference. Okay. So that's just showing us that it's like very unlikely to be the 50 basis points. And you could see the 2-year Treasury yield. Imagine this, like looking at it back in, let's say, September. Look at this, 0.25. And now it has gone up and up and up, skyrocketing for the most part. Looking at what's been happening over this period, it tells you that clearly the bond market is signaling something very different than what others are suggesting. So the markets can be manipulated and so on. That's more with the stock markets. But the bond market, in a sense, it's massive. It's hard to sway it in one direction or another. Standard deviation of the U.S. Treasury 2-year daily change versus the rolling 12-month move, the highest since Volcker's intermeeting weekend cut in October 1979. So it just shows you how fast these things are moving. That's all I'm trying to suggest. But the amount of money that's been moving in right now into the stock market, into bonds, we'll talk about that in a second here. Largest 4-week outflow from cash and, these money market funds, okay, that's money on the sidelines, which I disagree with that term. And you could see what had happened here. Money clearly moving out. On the right-hand side, the largest 4-week outflow from corporate bonds since April 2020. Then we see this bullish sentiment falling to its lowest level since August 2020. Okay, we're seeing a trend here, and the biggest reversal in credit. So something is definitely going on. Money is leaving corporate bonds, apparently not leaving equities. All clients were net buyers with retail leading. So you're looking at this right now. Retail investors are trying to buy the dip. It wasn't much of a dip. If I look over, actually, we could look at that together. You could see that. So we got this little dip that came in here. I don't really like to call it a dip, but for the sake of this video, it came down. And during this period of time, during this bounce, retail traders have been buying in. What does that mean for people now that, it's back down to underneath that 200-day moving average? Well, we'll see a lot of tensions right now. We're seeing activity with Russia. I was going to do a video about that. We'll see. And, of course, what's happening with the bond market, very, very serious to say the least. Now, let's go quickly into this right now. What's happening with the individuals out there? I mean, the bond market's one thing and stock market's another thing. But what about the individuals, the people? Well, we've got this. U.S. consumer sentiment falls to a fresh decade low on inflation. It's so important to see this because, of course, as you know, the U.S. consumer is the engine. And without that engine, that vehicle's not moving. Okay? Inflation's toll, U.S. consumer sentiment, fell further in early February amid rising prices. This has been declining. Of course, by the way, you can see it on the chart. After having such optimism leading up to early 2020, not doing good. Not doing good. It started to climb back up throughout 2020 into 2021, but it's just falling further than where it was in March 2020. Because, of course, inflation. Things are becoming so expensive today. Share expected finances to worsen. That number continues to increase. Not a good sign. And you see things have been increasing in price dramatically. Inflation from January 2020 to 2021, just showing you all those price increases. Same situation today. Everything across the board, for the most part, has been increasing. You stayed into the end. I've got something interesting connected in with what I had talked about previously, many times, in fact. The Federal Reserve members, they've been trading stocks, they've been profiting. Some cases, not all cases, but they've been perfectly timed. But it's not just the big boys like Powell and Clarita and all the others. Fed staff reported securities trades amid banks' 2020 stimulus moves. That's right. Fed says employees complied with the rules, some trades made by family members. Hey, just letting you know, we're about to put this through right now. It's going to be a couple trillion coming your way. All right. Well, it shouldn't surprise anybody. Okay. Like I said, all the stuff will be in the description as always. This is so important to follow the activities of what the Federal Reserve is doing on a daily basis. I will say it a million times, and I'm probably just going to stop talking about this altogether. Maybe I'll just make one video to kind of finalize my thoughts on it so that I can just reference that video in the future, just like I've done with the stock market. There's, by the way, if you type in 60 seconds the money GPS, you will get the video that talks about how I've outlined it before. Watch the Fed's balance sheet and you will see what happens with the stock market. But anyway, the Federal Reserve. I do not believe that the Federal Reserve wants to actually perpetually support the markets. I mean, look at history. There have been crashes. There have been cycles. When you crash a market, when you get to that bottom, maximum fear, not 2020. No. Totally different. When you get to the bottom, when there's actual true fear, where everybody is saying, sell everything. Think about financial crisis time frame. People were unloading homes, like very few people were actually buying in. That's max fear. At that point, who buys in? Oh, only certain individuals. Only the very astute, only the big businesses, only the ones that are getting that little tap on the shoulder from the big boys. And it's, always during that period of time, just to let you know, we're going to be pumping in a few trillion. Oh, you are? All right. Now we buy this and we buy that. Until that time, everything's up in the air, of course, but never, ever let somebody make you believe that the Federal Reserve wants to support the markets perpetually. It is a controlled demolition and a controlled, I don't know what you want to call that, escalation or pump up. Always remember that. If you appreciate this information, hit that thumbs up button. I do appreciate it very much. If you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.